Hello and welcome back to another video. It's been a while and I'm going to run through another section A and this time it's going to be a 2021 paper as you can not see from here, but I can guarantee you in the top right here you can see maybe there's a 2021 macro paper. You can tell that because it's paper 2 and it's a whole A-level paper. They didn't release, or there hasn't been a released AS level paper that I can find that is publicly available. So we're going to go through this. I'm going to run through all the working. As usual, I'm going to explain all my reasoning. I'm going to hopefully end up with full marks for the first section. And hopefully it will serve as some way to aid you in your revision purposes. And if you have any questions, just let me know. Just chuck a comment down in the video and I'll get back to you as soon as I can. So, as you can see here, we would typically have 30 minutes to spend on this. Most candidates want to rush through it, get through it as quickly as possible so that they can get onto more difficult content in section B, which I will try to get onto in later videos as well. So let's get started. After the global financial crisis of 2008, the US president introduced expansionary fiscal policies, so increasing government spending or decreasing taxes. That's what they are doing. Just put a little note there, just in case that helps you with revision for whatever reason, of 800 billion. The International Monetary Fund, IMF, estimated that the multiplier at the time was approximately 1.5. So what they're saying is £1 of spending would be £1.50 impact on the total economy. Which one of the following is a withdrawal from the circular flow of income? So this is money leaving, when we think about the circular flow of income, money leaving the economy. And exports is incorrect. That is an injection into the circular flow of income, because even though goods are leaving the economy, money is coming in to spend as expenditure on those goods that have left the economy. So that's an injection. Government spending is also an injection. If money is spent by the government on projects, for example, like infrastructure, that is an injection into the economy. Investment is also an injection from businesses, business expenditure on capital, machinery. So the only thing where money leaves the economy is taxation, and that could be direct or it could be indirect taxes. Direct being taxes that you can't pass on to someone else. So, for example, corporation tax or income tax. And indirect taxes are usually tax on expenditure, like VAT, for example, value added tax. So that's question 1. Calculate the total final increase in US agri demand as a result of the president's expansionary fiscal policies, assuming no other changes, ceteris paribus, as that is trying to say. So nice and straightforward. All we do is we take the value of our multiplier and we multiply that by the total amount which they have spent. In this case is $800 billion. And if you whack that into your calculator, then you should get, well, half of 800 is 400. So it should be 1.2 or 1,200 billion. 1,200 billion. It's important that you make sure that you get your units correct, because they'll be very, not stingy, but they'll be very strict as to how you answer the question. So 1,200 billion. And you see we get all this space. We don't need all that space. It's just a waste of time. All we need to do is make sure that we have the right answer down. Okay, explain the impacts of annual fiscal deficits. Okay, so annual fiscal deficits is when government spending is greater than taxation on the US national debt. Now, the US national debt is the sum of all of the fiscal deficits or surpluses that a government has had. So it will mean that if there is an increase in the fiscal deficit, there should be an increase in the size of national debt. So the impact of annual fiscal deficits, the impact of annual fiscal deficits would be an increase in the size of national debt. And we can add in, an extra bit just to explain this. So the fiscal deficits will be financed through government borrowing, which is usually when they issue bonds in order to facilitate their expenditure. Borrowing. And I'm going to put issuing gilts. These are government bonds, increasing the size of the national debt. Now I think I've gone a little bit overkill there, but I just want to make sure that I get the final answer and I get all 2 marks there. There we go. So just a comment on that if there was a fiscal surplus, actually it would reduce the size of the national debt. Which of the following diagrams illustrates the impact of an increase in net exports along a Keynesian long-run average supply curve? Okay, so remember, aggregate demand is C, consumption plus investment plus government spending plus net trade. They're saying net exports. What they're saying is this bit here, X minus M, that's the net exports. If they increase in net exports, that means the aggregate demand is going to increase. So if that increases, aggregate demand increases. So we're looking for any outward shift. So we can immediately get rid of this one. And we can immediately get rid of this one because it's not right. It's not going to give us a increase in net exports. There's a decrease in net exports, which would decrease aggregate demand. So we only have A or B, and this B here, this is a classical LRAS curve, and it is wrong. So the answer would be A. That is the Keynesian LRAS curve, that you cannot be operating at the full employment output line here in the long run. That's what Keynes believed in. Using the classical LRAS curve, explain what will happen in the long run to real output if aggregate demand increases. Okay, well, there will be no change what happen in the long run to real output. There will be no change to real output in the long run. And I can draw a diagram here to explain that. So here is my price level, my real GDP as it's a macro diagram. Here is my classical LRAS curve, LRAS. Here is my aggregate demand curve, ED, and I can say that this is the full employment output, YFE, that's what it means. So we're utilizing all of our factors of production to the most extent. Here's the price level, and here is our outward shift of aggregate demand. And you can see that the price level increases, but there is no impact on full employment output. Classical economists believe the economy will be at full employment output in the long run. There we go. Okay. Explain the likely impact on aggregate demand of a fall in average house prices. Okay, so here, if there's a fall in average house prices, there's likely to be a negative wealth effect. Households are going to feel less rich, less wealthy, and so they're going to reduce their expenditure. So it's likely that aggregate demand will decrease. So AD, aggregate demand, will fall due to a negative wealth effect. Which will lead to a fall in household consumption. And, well, decrease AD. That's essentially it. Maybe there'll be a reduction in consumer confidence as well. But that's all we need. British pound to US dollar exchange rate, value of £1 in US dollars. Okay. June 2017 to June 2019, which one of the following has been the overall change in the British pound to US dollar exchange rate from 1st January 2018 to 1st January 2019? Okay, so £1 could previously get us around $1.35, and then £1 can then only get us $1.25 in 2019. So you can see here that there has been this downward trend, and if we can buy less with it, that's a depreciation. The value of the currency is lower, and we can see that we can't buy as many dollars as we were able to previously with our £1. These two here are to do with fixed exchange rate systems, so we don't need to worry about those, as the question's asking about a floating exchange rate. A revaluation is an increase, it's the same concept as an appreciation, and a devaluation is the same as a depreciation, a fall in the value. Explain the likely impact of the change in the exchange rate of the pound shown in the graph from 1st January 2018 to 1st January 2019 on the UK current account on the balance of payments. Okay, so there has been a depreciation. The value of the pound. And with this 4-mark question, you need to make sure that you are applying application. So you need to reference the data, the graph that's been given. There's been depreciating the value of the pound from, let's say, £1.35, £1 to $1.35. To £1 to, just change this quickly, to $1, I'm sorry about that squiggly horrible line, $1.25. That's where I know I'm going to at least pick up 1 mark for referencing the data, okay? If you do that, the idea really is that there'll be an improvement in the trade in goods for the UK because they'll become more price competitive. So there should be an increase in the value of the exports to the US because they appear cheaper to US consumers of either UK goods or UK services. So we could say that the current account would improve, and the UK has a current account deficit. Therefore, there would be a reduction in the size of the current account deficit. And I'm going to put CA, current account deficit. And I can explain, this is because UK goods and services will be cheaper to US businesses, consumers, which will increase the value bought. Value of exports from the UK and reduce the deficit. Because the pound has depreciated, which means that the other currency, whatever currency we're pairing against, must have appreciated, must have improved in value or increased in value. The cheaper US will increase the value from the UK and reduce the deficit as UK goods and services will be more competitive. There we go. Question 4. A number of business groups have signed an open letter to the UK government asking it to commit to delivering the full high-speed 2 rail link HS2, which has been scrapped now. This will connect London to the northern cities of Manchester and Leeds at a cost of 56 billion and reduce journey times by as much as 50%. Explain one likely impact of this project on aggregate supply in the UK. Okay, well, this is what is known as an interventionist supply side policy. It's done deliberately by the government to correct a market failure, in this case the lack of travel infrastructure between these cities. Interventionist supply side policy, just put that in the top there. So, as it's 4 marks again, we need to make sure that we have application. We need to refer to something in here. Now, I would probably refer to maybe the reduction in the journey time, for example, here, or you could talk about the cost of it, something that just make sure that you reference something. So, how can we answer this? We'd say that if there is the introduction of HS2, it will increase long-run aggregate supply. As it is an interventionist supply side policy. Now we'll come on to that in a second. I can draw a diagram. You can don't ever be afraid to draw diagrams in these answers. Here we go. Here's the price level. Here's real GDP. I always use Keynesian LRAS curves. There's LRAS 1 and there's LRAS 2. And there's my AD curve, and we can show the outward shift. Always show your equilibrium points to illustrate that the price level will fall and there'll be an increase in economic growth. The arrows are not necessary, you do not need to show the arrows. So, this is our explanation. As a result of the reduction in journey times by 50%, labour will be able to find jobs easier. And travel to work more easily. This will improve the quality of labour, which is one of the factors of production. Cause an increase in the productive potential of the UK. There we go. So I've done this, drawn my diagram, should get me marks, and explain that it's an interventionist supply side policy and the AS will increase. Good, should be 4 marks there in the bank. Government spending on the HS2 rail link example, which of the following? Well, we should know that it's not automatic stabilisers, that's to do with welfare payments. So this is wrong. Capital expenditure is correct. Current expenditure is wrong. It's to do with the day-to-day activities of the government, like spending on wages, for example, or public wages, like doctors or nurses. And transfer payments is wrong as well. These are welfare payments again, usually welfare payments. So good hint, good tip, always remove the incorrect ones, increase your chance of getting the correct answer. That should be fine. Okay, the last question. GDP at purchasing power parities, Germany and France, nominal trillions of US dollars 2010 to 2017. From the data in the graph above, which one of the following may be deduced? So, France's rate of inflation was lower than Germany's in 2017. We don't know because this is in nominal trillions of dollars, which means that it's not accounting for inflation. So we can't actually figure out, it doesn't give us any indication of what the inflation rate is. So we can immediately get rid of that. A is wrong, don't know what that is. Germany's GDP is smaller than France's in every year shown. GDP at purchasing power, normal trends of 2010-2017. Germany's GDP is smaller than France's in every... Okay, so Germany is this dark line here, and actually their GDP is larger than France's in every year shown. So actually this is correct. Incorrect, sorry. You can see that 3.41 is larger than 2.64, and that's the same for every single year. And so there's no way that is correct. In every year that France's GDP fell compared to the previous year, Germany's did too. Well, let's have a look. 3.76 to 3.54, 2.86 to 2.68, that's correct. 3.90 to 3.38, 2.85 to 2.43, correct. And then no final indication. So this is looking correct. We'll just check the last one. The GDP of both Germany and France fell between 2015 and 2016. 2015, they both increased. So this is incorrect. So we should be sure that C is the correct answer. Okay, the last couple of questions. Calculate the percentage change in Germany's nominal GDP from 2016 to 2017. Okay, so percentage change is really straightforward. You do new value minus old value over the old value, and then you times that by 100. So in this case, 2017 is the new, and 2016 is the old. So 2016 to 2017 for Germany. Okay, so 3.69 minus 3.5 over 3.5 times 100. Just double check I got my stats right. Yep, okay, so then that would be 0.19 over 3.5 times 100, which if you type that into your calculator should give you 5.4%. So I would typically go to one decimal place. And then finally, explain one reason why purchasing power parities are useful. Typically it's to be able to improve accuracy when comparing data between countries. And so you can account for the cost of living in those, for example, by accounting for the cost of living within those countries. So we'll get with that. So we can say to improve accuracy when comparing for example the PVP accounts for the changes or the differences in the cost of living between countries. So for example, in China you may be paid less than you would do in Switzerland, but Switzerland is much more expensive to live in than it is than in China, and therefore in order to account for the different costs of living, we can use purchasing power parity to get a better understanding of changes to data in those countries and account for the fluctuations in the data more accurately. Okay, so there we go. We have done section A all 25 marks. You give them 30 minutes, and we haven't used the whole time, but we have just been thorough in the way that we've answered each question. I hope this has been useful for you. If you have any questions, as always, pop them in the comments and I will get back to you as soon as possible. Otherwise, I hope this has been really useful, and if it has been, drop a like, subscribe, and thanks very much. I'll be back as soon as possible with another video to help you get through your A-level economics. Thanks, bye-bye.